So today we're going to discuss the idea of using super to help you buy a home faster. So you might have heard of the government scheme, which is called the First Home Super Saver Scheme.
Yeah, I'll give you my best explanation of it. The way I like to explain it to people is that, from what I've read, you can understand it in two fairly independent boxes, which is that you're able to put money into super. There's a cap on your, what they call concessional contributions every year that you can put in. I think at the moment it's about $27,500. And what happens is if I'm earning $100,000 a year from my job and my employer's putting in, say, $11,000 a year into my super, I don't know what the exact percentage is at the moment, that takes up $11,000 of that $27,500, and I have $16,500 left over that if I'd like to, I can put extra money into that super. Some people talk about salary sacrificing the money in, which is a topic, but it is fairly similar to the simpler way that I do it, which is that I just take money in my bank account and I just send it to my super fund. Literally like just savings I have. And what happens is when I send those savings to my super fund, two important things go on. One is that the super fund takes my money and invests it according to your portfolio. So let's imagine, for argument's sake, I go and put $10,000 into my super fund of cash in my bank account. So they'll go and take that, but they will tax 15% of that going in. And what that means for $10,000 going in is they'll tax, is it $1,500? And they'll invest $8,500, and that's the money that's invested. So that's part one of putting it in. But part two is that come tax time, you can claim that full $10,000, assuming that you've followed the rules on your super fund website, which aren't that complicated, but you do need to go and kind of read them and follow it. And you get to claim that $10,000 as a tax deduction. And what that means is that, let's imagine that you're in a tax bracket where, for simplicity, you're paying 32% marginal tax rate, like an average Australian is, at, say, I think it's the average salary of about $80,000. That means that you get to bring your $80,000 taxable income down to $70,000, which will save you some money at tax time, or like approximately $3,250.
So however you choose to do it, whether you do it like salary sacrifice or you do it using your after-tax wages, the tax outcome is the same overall, isn't it, at the end of the year?
Exactly. And salary sacrificing, I think, is popular because it's less admin on the way in, obviously, because it just comes out, your employer does it for you. And then I've heard some people say that salary sacrificing is just kind of nice because you don't have to make a choice. You can't forget it. You can't have second doubts on yourself. It just kind of happens automatically. Depending on whatever your income tax rate is, if you imagine that scenario, you put money into your super fund, you lost $1,500 in tax, but then you saved $3,250 on tax because of the deduction. So therefore you save, what's that, about $1,700. So come your tax return time, you end up being about $1,700 better off. And again, that's based on a whole bunch of assumptions. So that's the putting money in part, if that makes sense. I assume you're across that one, Dave, because that's not anything new and that's not related to First Home Super Saver.
That makes sense. That makes sense to me, mate. So how does that part relate then to the First Home Super Saver?
So the way that relates is that when you then go to buy a house, or in my case, an apartment, around the time of buying the apartment, I think it's something to do with like you have to lodge it before contract signed or something. Again, go to the website. It's all written pretty clearly. It took me 5 seconds to Google it. You can go onto the ATO website through MyGov and you can basically request to get that money that you put in out, or some of it more specifically. And there are rules around how much of it you can get out. I think the rules at the time of this recording are like you can get up to $50,000 in total and only like $15,000 per year of contribution. So to put that another way, it's like if you put in $20,000 in 1 year, then for that year later on, you can only pull $15K out.
Yeah, $15K is the maximum you can put in per year while still being able to pull that money out later. Is that right?
Correct. So if you put in $20,000 this financial year, that $20,000 can go into your super, assuming you don't hit the concessional contribution cap, which is a separate problem, but you can only pull $15K of that out. You can't pull that extra $5K out. So those rules aside, you can pull that money that you put in out of your super. You obviously can't pull the money out that your employer put in, but you can pull the money you put in on top of that. And then you can basically use that to either pay for the home deposit, or I'm pretty sure you don't actually, I should double check it, but I don't think it strictly needs to go to the deposit. You could use it to just pay more of your house down or offset the money in some way. And I think the important thing to note, which Dave and I were kind of discussing earlier, is that you do actually get taxed on the money potentially as it leaves the super fund, depending on your income. And that's a bit of a hairy thing, but essentially what it does is if you pull $10,000 out of your super fund, it comes in and is treated like extra income and increases your taxable income. However, on that portion, you pay your marginal tax rate minus a 30% offset. So for some people, what that means is if you did that, you will pocket some extra cash at the end of it all, or you could end up losing some cash at the end of it all, depending on your personal circumstances.
You essentially are able to contribute up to 15 grand per year, say, for the purpose of this scheme, where you can use it to build up a home deposit, say over 3, 4, 5 years in the future. And you can then pull out 50 grand only of the money that you've put in. But then I also think, Hayden, tell me if I'm wrong, that 50 grand does not include the earnings on that 50 grand. The earnings are on top of that. Is that correct?
Yeah, that's correct. So they look at it purely on what you put in. No tax. It's literally the cash that left your bank account is the amount you can claim back. And to give you a concrete example, Dave, I think I put in 18,000 a year for 2 years or something. That was my main deduction. My main way to save money was to dump it in super. And because I put 18K in for 2 years, the most the government would let me pull out in that example would be 30. Even though I put in 36, I could only ask for 30 to get out.
And so you're also able to combine you're able to use this strategy alongside a spouse if you have one too. So that kind of, you can in a way amplify this, where you're both contributing to your own super, and then you're able to pull out, what would it be? That would be 100K in total later, provided you put in that much to start with over a period of, it would have to be quite a few years there, to then have 100K to use as a home deposit later on. Is that right, mate?
Yeah, exactly. And it's probably then worth mentioning that, like anything, like tax, stamp duty exemptions or other schemes, there are rules around it. So for instance, if you've already bought a home before, you can't pull that money out of super. Again, nothing stops you contributing it, but if you bought a home before, you can't pull it out. So I didn't pull it out. We'll get to that in a bit. But because I've now bought an apartment, I am no longer able to pull that money out of super for any future property purchases. And there's a few other things around, you obviously can't do it from investment properties and things like that, because it's the government trying to find ways to help Australians, get their home soon and live somewhere stably.